the people in America, they wanted to challenge their government, and they said, you know what? If you want to ban a Chinese app, we will go to use the most Chinese app, the Red Note or the Little Red Book app. Hi, everyone, and welcome to the 22nd episode of the VC React podcast. Every week, we break down startup news, VC moves, and investment stories with some of the sharpest minds in the business. Let's jump right in with Andrea Azzolari, Senior Associate at Plug and Play Saudi, Ayat Al-Sabbag, Investment Principal at Suhail Ventures, and Julien Plouzeau, Senior Partner at Oraseya Capital. And as always, from FWDstart, my co-host, Jamie Lane. In the video description, you can find more details on our guests, their LinkedIn profiles, and links to their company's websites. Our weekly news are brought to you by FWDstart, a twice-weekly newsletter that breaks down what's happening in the MENA startup, VC, and tech space. Welcome to the show for the first time, Andrea, Ayat, and Julien.
Pleasure.
Thank you, Ahmad. Thank you for having us.
Julien, you were on the news yesterday. It seems that Oraseya Capital has been the most active investor in the UAE for 2024. According to Magnet, which we hosted last week. Congrats. How many startups did you invest in last year?
Yeah, thanks for picking this up. So for us, like last year was the first year at Oraseya. We launched officially launched the fund in November 2023, but we started allocating and deploying on the 1st of Jan. So last year, for the first year, we've closed 24 investments. So we have two streams. I'm not too sure if people are familiar with that, but we have a very early stage pre-seed and seed stream with Sandbox, which is an investment program through which we invest $150,000 plus. So we've closed 16 investments, like first ticket investment through Sandbox last year, and 8 later stage investments. So we're very active in the Series A plus when we invest from $500,000 to $3 million, with a sweet spot around $1.5 to $2.5 million. So we've led a few rounds last year, and yeah, we want to do more. So we didn't close any pre-B or B round last year, but now we're working on that for Q1 and the upcoming months.
With 24 investments, I'm guessing you covered multiple industries. And in today's episode, we will discuss new big funding rounds and PropTech, FinTech, AgriTech, and of course, AI startups. Okay, and now let's kick it off with the first story. What's happening this week, Jamie?
Yeah, let's kick things off on the PropTech front then, if you'll allow me. So we'll start off in Saudi, where rent now, pay later, I suppose it is heating up as far as competition there is concerned. I guess we have 3 startups now. Ajras obviously focusing on more on the commercial side of things, Azzolari, residential, and Rise now bolstering their war chest, raising a 35 million Series A. So a combination of equity and debt funding there. So the round itself was led by Ride Ventures, participation from Sidra, through its second fund, as well as Akar. I think that's the largest sort of property marketplace in Saudi as far as I'm concerned, and a really interesting partnership as well announced as part of this announcement, in that they're planning to actually integrate Rise's RNPL service into the platform itself, which I think is an interesting development. Interestingly, Akar also backed Azzolari's 14.65 million seed round earlier this year as well. So they're hedging their bets, perhaps, as far as that's concerned. In terms of background to Rise, founded back in 2021 by Ibrahim Bilala and Mohammed Al-Frehi. I think that's a pretty good pronunciation for me, actually. In terms of, I think we're all familiar with RNPL at this stage. The idea obviously allows tenants to pay their rent in flexible monthly installments. So I guess the norm being in Saudi that generally, and UAE to a certain extent, that it's, you need to pay in much larger chunks. The benefit here is that you can break it down into 12 monthly installments. Property owners receive it upfront, and the tenant gets to pay it to the particular platform on a monthly basis. Interesting as well in terms of the debt financing came from Partners for Growth, again, which also provides the debt financing for Azzolari's seed round back in October as well. So yeah, interesting development. PropTech's gonna be busy.
So those are competitors. They received funding from the same investor.
Yeah, from what I can see, I'm open to correction on this. They do seem to be both focusing on residential for the time being, as far as I'm concerned. So yeah, both received the debt financing from the same company.
Okay, maybe we should start with that. This is a Series A round, still early, and they have both debt and equity. This is not common on such an early stage. I see that the combination of debt and equity later on, and maybe Series B plus, maybe C plus. But on a Series A, what do you think? Is this going to become more of a common funding structure in MENA?
I think for business models like Rise, it does make perfect sense to have this, mix of equity and debt. And, Rise, like they do the installments for rent for the end users, but they pay the full amount upfront for the property owners. So having that financed early on from equity, it doesn't make, it's not sustainable in the long term. It will dilute founders, it will dilute investors. Not everyone will be happy. So for the business model that, have this much of costs at the beginning, it does make perfect sense for Rise to integrate the debt financing early on. And I believe the equity investors, they wanted to see that debt component up early on for them to participate and double down on it. Like even the seed investors from the early on, they were pushing for, having that debt facility or having some kind of, that's not dilution capital, that's not diluted for the founders or the investors. It actually reminded me a lot of, when they have the early days of Tamara and Tabi when they first started in the market. Like also it was a new market. They built another whole niche, and then it wasn't the best, or it wasn't the most affirmative for the investors to participate in this round or in this new market. Is it going to work in Saudi or GCC, especially with a high purchasing power market like the GCC? But then, it went like crazy. And then we see the debt financing round started, becoming bigger and bigger. So the market kind of had like first round with Tamara and Tabi. They had that first experience with them. So it becomes more familiar, with the debt financing for such business model that has heavy financing from the early on. So we have the Partners for Growth. We also see a lot of other venture debt, being established in Saudi or in GCC who are willing to support startups like Rise. And it does make sense for them. It's better for the founders, for the investors. It does, I would say, put some pressure on the scalability, long-term profitability, and how this business, can be in 5-10 years from now. I think that's a lot to think about from a founder and business model point of view. But overall, for this business model, and I would assume it will also work for logistics, something that's asset heavy, it does make perfect sense for us to go with that route.
And do you see any conflict in having one investor investing in two companies? I know maybe this is debt, it's different. It's not the equity investor who invested in two competing companies, it's the debt one. Is there any conflict?
Look, honestly, I think the market can take more than one player. So like we have Tamara and Tabi, we will have Rise, we will have Ijari. I think we'll have even more players coming on. So the property market in Saudi is huge. How about if we expand more into GCC? So having that player, I'm sure they have a lot of work to do in the background of how the future support of these companies will look like. But the market can take more than one player, and having that supporting from the beginning, especially since we don't have that much of venture debt provider now in our region, makes sense.
Yeah, I don't think there's any conflict from like a venture debt provider standpoint, because in any case, you're not building like equity that you want to appreciate in the future, so you're not investing in direct competitors in the purpose for you to see who's the winning pick in the market. What you want at the end of the day is your debt being serviced and being repaid. And it's just a function of like assessing the default rate and what type of IR you can get. I think this is a good business model. And we've seen that also like in UAE. I think Keepers, that was last year, raised a very similar amount, $34-35 million with a mix of equity and debt. And that would work very well, because as a debt provider, you're looking at probably 15% IRR. And that's great. If you can de-risk that, if you know in the loan book the default rate is really low or close to zero, it's pretty secure investment down the line. So for a company like Rise, as Ayat was saying, the business model, with this business model, you need to raise funds. It's a necessity for you to scale. It's pure working capital with upfront payments you collect on a monthly basis. If you want to service more customers, because you're a debt provider at the end of the day, then you want to make sure that you maximize your pool of debt available to you, but then you have to balance unit economics because debt costs you, and then you pass this cost to your customers, which means your contribution margin can get quite low. But technically, the better you are, the better your book loan is actually, the lower the cost of debt should be provided to you. So of course we don't know PSG, what's the cost of the debt to rise, but hopefully from a pure economic standpoint, it makes sense to rise and have a few bips in the margins enough to make some good money.
Makes sense. Andrea?
Yeah, no, look, when I read the news, I was very happy about it for two main reasons. First, the PropTech space, I really love it. We as Plug and Play, we placed a couple of bets in the PropTech space in the region relatively recently, also in the last couple of years. If we look at the overall evolution of the PropTech space in GCC, and we sort of like look into, I would say, the main vertical. So you have the architectural and design, you have the property management, the commercialization, and also the construction. I think pretty much in every sub-vertical, we've been having great success stories in the region, like, commercialization, Yes Keeper, there is Stake, there is Jari. There is also Haspi from the UAE, which are very large. On the construction side of things, you have Tendered, you have Bricks. So I think, it's a trend that is somehow consolidating, basically following great success stories and also following what, the market is basically, the direction that the market has been taking. And then the second thing that really made me happy is that, we're talking about debt financing, which is not very common. Not many founders know that they can raise, capital also via debt instrument. And I think it's something that, with especially late stage VCs not really be present in the region at the moment. Majority of the funds are early stage. So I think, looking into debt, or let's say more exotic, if you want to call it that way, avenues of financing, it's something definitely that the founders would need to get more educated on and start looking into.
Before I move on to the next story, is PropTech really heating up in Saudi or in GCC? How many investment deals do you see in PropTech every week, let's say, or every quarter?
It's absolutely booming. It's one of the hottest sector right now. Like, I think in December we had the VBAN exhibition in Riyadh. Majority of the startups were just focused on PropTech real estate, whether we're talking about property management or the financing or the tenant management and so on. Some of them are direct B2C, some of them are doing B2B. And we're seeing also some, push from the government into digitizing every aspect, including the real estate market, whether that's from paying rent to verifying the contracts to managing, property developers and everyone that they work with. So we see a lot of push, from the upside and also from the technology providers here in Saudi Arabia, and investors are loving the space. It's a new space. It's a huge market that needs to be disrupted still in Saudi. So we're seeing, talking from a pipeline point of view, a lot of startups are coming from a PropTech aspect, but very interesting business model, I would say, we're seeing right now.
Yeah,
Andrea, you're focusing on very early stages and seed stage. Do you have any percentages for the applications coming from Saudi and PropTech?
Percentages in specific number, no, but definitely, I condone exactly what Ayat was mentioning before. Definitely a rise into property deals, especially. Defining PropTech, it's a bit tricky, right? So what are we looking at? Are we looking at purely PropTech? Are we looking with PropTech with a FinTech touch? I would say it's generally speaking a little bit tricky to do a proper classification. But definitely, again, I condone what Ayat was saying before. Rise into PropTech solutions, and I think Ayat mentioned a very, very, very interesting point, which is now government, especially in Saudi, so specific governmental entities are really pushing on innovation on the PropTech side of things. So, for example, real estate general authority is doing a lot now. And this is coming in waves, right? So if we look at Saudi ecosystem, we've been seeing first a lot of innovation being done into, general digitalization or FinTech, which is, classic of very early stage ecosystem. And now, there are other sectors that are following. And I think, again, PropTech is going to be definitely an area where, across the verticals I was mentioning before, so both from the design, commercialization, managing, or even the construction things, we're going to see more and more solutions, because also the private sector is starting to activate a little bit more. So looking for innovative ways to become more competitive and also offer better services. So definitely an interesting space.
How about in Abu Dhabi, Julien?
Well, Abu Dhabi and Dubai, UAE, it's clearly booming. Like just last year, we've closed 3 investments throughout the value chain, the PropTech value chain, from construction to rentals to even like data play, and we see more and more coming through through the market, which is quite interesting. Of course, there's a massive drive from the government to digitize, as Ayat was saying. We see the same on the private sector. For us, with the fund of DS is, is a massive real estate operator through our 3 economic zones, Econ Oasis, Dubai Port Field, Dubai Commerce City. So we know this space pretty well. And yeah, it's clearly a hot sector, and we know we'll do even more this year. But it's quite interesting to see also what's happening in Saudi, because we have less exposure to Saudi because we're pure like UAE funds, and seeing like how fast it's moving over there, it's really encouraging to see this sector booming throughout the region.
Well, FinTech is always hot. Jamie, take us to the next FinTech story.
Yeah, I was going to say, let's go back to a perennial firm favorite in FinTech, Egyptian FinTech startup in particular here, Money Hash. So they've raised a 5.2 million pre-Series A funding round. So that brings total funding to over 12 million since its launch back in 2021. It comes pretty quick on the heels of their 4.5 million seed round as well, which was just early 2024. That was led by Co2 and Sukna Ventures, along with others. In terms of what the startup does, specializes in payment orchestration. So essentially simplifies complex payment stacks for merchants across the MENA region via APIs. So obviously important, especially in emerging markets, where obviously you have diverse payment methods, high failure rates, and obviously always a challenge of cart abandonment even. So I guess initially Money Hash was more focused on the small merchant side of things. In 2024, they have sort of pivoted the focus slightly to also attract larger enterprises as well, and they've achieved a threefold increase in enterprise customers. So it makes up now about 35% of their customer base. Key clients include your Damaras, Kitopi, Brands for Less, etc. This particular round itself was led by global fintech investor Flourish Ventures. Other investors include Vision Ventures, Arab Banks Accelerate, Emergo Capital Ventures. Also a couple of interesting angels as well. So for instance, GitHub's founder Tom Preston Werner also participated. He also participated in the seed round or the pre-seed. And we saw Co2 Ventures return as well. So yeah, Money Hash going from strength to strength. I think they're based in San Fran as well, as far as I'm aware, but focusing on the MENA region.
I love that. It's a global company from day one, it seems. They're starting with one market, but they have their eye on the globe everywhere. But hey, maybe I'm getting old or overwhelmed by all these fintechs. Can somebody tell me exactly what they do? Because they all seem similar to each other, doing the same thing. Everyone is doing payment orchestration or payment gateways. Can someone explain what exactly Money Hash is doing and how it's different from others?
Yeah, I'm happy if you want to start.
Yeah,
in a few words,
please.
For me, it's a payment orchestration. That means they will connect like all the type of payment gateways that are available to you in a country and a region. And what they will do, they will route the payments with the less effort, let's say, in terms of like failure, because payment can fail through a payment gateway. So we'll reroute automatically to the second one until actually the payment succeed. That's one. Second will be on the KYC or customers, making sure like you limit the number of flows going through. So you might actually connect through different third-party services that will run the KYC in parallel of the transaction. So again, the transaction won't fail, or like there's more chance of transaction going through. And also that would probably do an arbitrage between different platforms according to the size of the payments, to the currency, exchange rate, and location when you are, to minimize the transaction cost. So instead of paying 2.7%, you might end up paying 2.4%, 2.3%, which at scale make a massive difference for e-commerce and any online pay. So that's my understanding. I haven't looked at this startup specifically, but that's how I would summarize payment orchestration as the.
Okay, so they're based in the US and they're servicing the MENA region. Given the fragmented regulatory and technological landscape in the region, what challenges do you think they will see scaling their services in such a complex market, especially in FinTech, highly regulated?
Yeah, well, I think what you mentioned is going to be the biggest challenge for them, like the regulatory frameworks in each country, whether that's in Saudi, in UAE, in Egypt, especially that each market has its own characteristics in terms of payments, in terms of the different currencies or what they can accept, where they cannot. Are they taking cash on delivery? Are they not? Are they, more of a digital payment country, for example, especially like Saudi becoming more and more relying on the digital payments more than the cash on delivery aspect. But the regulatory hurdle, especially in a market like MENA, it's overall, it's a big market. But when you come with Saudi, UAE, Egypt, Jordan, whatever, the regulatory challenges in each one is going to be the thing that's going to take them the longest time in order to get the right licenses and then, expand the market base in each market of these. But the good thing is here, especially if we're talking, such as Saudi, the regulatory frameworks or the regulatory entities are being very much cooperative, very much open to work directly with the startups, even if they take some time, longer than expected for them to get them the right licenses or what they need. But they're much open to hear, to see what's going on. They're being very close having a close eye on the market, on the new startups coming on, making things easy, whether we're talking about SAMA, whether we're talking about CMA. So we've heard stories from a lot of startups that maybe it's not clear what required in terms of licensing for them right now, but the regulatory entities are working with them directly, like guiding them. Okay, now you can launch with this, then you come and see how the market reacts to your product, and then we can base, the mandate or the regulatory requirements for you based on that. So that's the good thing, is that it's not very strict right now. They are open to listen and work with the startups, but the regulatory framework in each one, will be, I think, the thing that will take them the most time to fully acquire each market.
Are they actually subject to any regulation? That's kind of the question I had yesterday when I looked at the news, because they're not processing the payment, they're connecting with the payment gateway. So I'm not too sure if, from a regulator standpoint, if I would cover this. So again, I don't know enough about this startup, but I don't know if you guys have any insight on that.
Well, I would assume they're more of an aggregation in terms of the payment gateways. In terms of licensing, also, I'm not very familiar with the insights of that business model, but all is possible, I'd say.
There are two schools. Grow at any cost. Don't think about profitability, just get market share, or focus and prioritize on early profitability to get your unit economics right, and then start scaling after that. Which one, as a VC, which one do you like or encourage more?
That's the classic debate of VCs. Do we go profitable or do we, maximize growth? Look, I'm going to talk from a VC point of view. I'm not, when I invest in a company, especially someone who has a first mover advantage, I'm not expecting profitability, especially if we're talking about FinTech for the first maybe, 3 to 4 or 5 years. But what I need to see is a path to scalable unit economics. So actually, even the founder of Zed was talking about this in a podcast, is for them, it was about defining the North Star metric that would scale the business model, or, maybe that's the number of deliveries, maybe the number of transactions, or a GMV. It's the number where when you reach it, you can able to unlock other revenue streams or unlock, maybe reach break-even stages. So especially in FinTech, if you are coming on with a new product to a market and you're facing all the regulatory issues and the hurdles for you to be, licensed fully, and then you are prioritizing profitability, but then comes a new competition and players who have that route easy for you because you paved it for them, and now they can maximize on growth and take the market share. So it's about, at the beginning, I would say, from a VC point of view, having that growth mentality in the first years, acquiring the market, but having the best scalable unit economics in terms of LTV, cost of acquisitions, and reaching the North Star metric for you to be able to unlock the potential of the full business.
Yeah, pretty much condone what Ayat was saying. It's, the forever dilemma. Should I go crazy on growth, or should I really look at, numbers and create a sustainable business from day one? I think it's forever dilemma that will never find, the right, like a proper and right answer. If you look at other, sort of like a similar payment orchestrator, like, Stripe or Adyen back in the days, they were growing massively and so prioritizing growth. But also now I think we are in an era where, that kind of sentiment and approach, or even from an investor point of view, has changed a little bit, especially over the last couple of years. So even from fintechs, you might want to, I wouldn't say expect, because expected, it's a big term, but you would want to see some sort of operational efficiencies and some sort of path to profitability. Maybe not from an early stage, like at the pre-seed and seed, but already, from a pre-series A, you would want to see some sort of indication that, the model can lead to those outcomes. So yeah, forever dilemma, I would say potentially, an in-between solution might be the good approach. But again, I think Money Hash has a very interesting advantage compared to other global competitors, which is being in MENA, understanding the MENA ecosystem, and also focusing not on SMEs but large enterprises, which is something that it's a bit of a different approach compared to other payment orchestrators. So definitely they have something that can give them an advantage, at least in the local market, in terms of expansion and growth.
Yeah, on our side, we always say, we favor sustainable growth, and ideally we want the best of both worlds. Realistically, for a fintech, we're really keen on having scale first versus positive unit economic levels early stage. For one simple reason, if you get scale really fast, you can win your market, you can tap in other markets, and then you can get closer to your customer and capture the value any other ways, like by different services, different add-ons. You can cross-sell, again, other products you can add to that, and that's usually those services that would add quite a high margin versus a typical payment gateway that would probably margin just a few percentage or points here and there. I think scale for a fintech early stage is critical, and then you can figure it out. Of course, if from the get-go, in the future, whatever or however you scale, your costs will always grow further than your revenues, and faster your revenues, then that there's no point. But if there is the hope that at least on the gross margin level, eventually on the net margin level, you can be positive, then yeah, I would privilege scale first for a fintech.
I like this balanced approach from all of you guys, because I think prior to 2023, whenever you asked this question, everyone was like, grow, no matter what, you can capture the value later on, right? And then after 2023, with the wave of valuation corrections and focusing on profitability, being realistic and what can you do, people started focusing more on profitability. So it seems like maybe it goes up and down with the market cycles. I hope we stay balanced in the next cycle. Anyway, Jamie, can you take us to the next story? Now we're moving to AgriTech.
Yeah, let's move to AgriTech and the very cleverly named Arable, who have closed a 2.55 million seed round. So I know the founder and CEO Lawrence. So we spoke last week. And gentle plug, I'm actually interviewing him tomorrow for next week's deep dive before it starts. So subscribe there if you do want additional context and background on what's involved in terms of.
You'll see the link in the description.
Exactly. What's involved in terms of building an MVP and hydroponics farm in the middle of the Saudi summer in the desert, which I'm looking forward to getting some more information on that. But in any case, as mentioned, they've raised 2.55 million seed round. So it's led by institutional and private investors. Currently 90% of this funding coming from foreign investors. Founded in 2024 by Lawrence and Christina. So they were part of Antler's first Riyadh residency program back in 2023. So they create hydroponic farms for vegetable production, initially focusing on leafy greens, to the best of my knowledge. And the whole idea, I guess, is that it's cost effective and locally just the desert climate. So I guess the differentiating factor with them is that, unlike hydroponic tech imported from the West, where conditions such as low sunlight, moderate temperatures are very different to the more arid climate of Saudi, the particular technology that these guys are using essentially 4 times faster, 4 times cheaper, and operates at 2.5 times lower cost compared to existing hydroponics solutions in the region. Another interesting fact actually is that 80% of the system's components actually can be sourced or manufactured locally as well within the kingdom. So again, I suppose decreasing that reliance on having to import foreign equipment and expertise. Obviously, regionally, the biggest player in the vertical farming hydroponic space is Pure Harvest, who have a pretty sizable war chest, 387 million in funding raised. And we've also seen consolidation, I suppose, in the vertical farming space as well recently. Pure Harvest obviously acquired Red Sea Farms, production facilities in Saudi at the tail end of 2023. Red Sea has since renamed Azzolari, and they've pivoted to more focusing on, I guess, their proprietary tech in terms of the greenhouse nets, etc. And they raised a $16 million Series A last year. Yeah, exciting. Hydroponics, notoriously difficult to in terms of being so, I guess, cash intensive in terms of the setup. Unit economics are difficult, but I'm rooting for them. I'm looking forward to finding out a small bit more, and I can chat to Lars tomorrow.
Yeah, let me start with you, Ayat, because you're in Saudi. There are big claims here. 80% of the components are sourced locally. I don't know if it's better or worse to source 80% or 85% locally. I don't know if you can compete with China on manufacturing such things or components. Also the claims 4x faster, 4x cheaper, operate at 2.5x lower cost. There are some big players in the market globally, right? And they export to Saudi when they offer the hydroponic or climate resistance farming solutions. How can startups like Arable with 80% local compete with all these big players and differentiate themselves?
I think it's too early still to say the impact of, such startup, considering they are still early stage on the market as of today. But the main driver here, especially in this sector, like when we're talking about AgriTech, it's more about the strategic importance of the sector, especially in Saudi, rather than the immediate returns, if we're talking about from an investment point of view. So here, for example, you have what's driving everything is Vision 2030 in Saudi. Big part of that is on being, internally sustainable, especially in terms of increasing the exports, decreasing the imports in the agri-tech or in the food sector. So we have, for example, a lot of ministries will try to push these innovations in these sectors. We see the Ministry of Agriculture, they launched their own accelerators, which also I think, Arable was part of the one called Symbiola. So having a close relationships with these guys in terms of support, in terms of maybe capital also, in terms of having access to the latest technology and how they can use out of that is going to be the main thing for Arable, to be more sustainable and try to compete with these guys. If we're talking about MENA or Saudi, it's going to be, of course, the localization of the solution to our very unique climates and heat temperatures here in the GCC. But the key thing, honestly, what I see is it's going to be a bit challenging because, talking with traditional VCs or the investors with such kind of sectors who will require a lot of time still to see returns. It's going to be having close relationships with the governments and keeping an eye on who's coming in and what they can, showing the strategic importance of the product and what they are building, how they can affect and influence the vision and work with them along based on that.
Andrea, back to you with the same question. You get so many applications. Is there any trend growing in AgriTech, or still it's not that active?
Yeah, I would say sustainability as a whole, it's not that active. I think especially at the very early stage in the region, it's a bit of a hard sell. And I think also this, the news of Arable, 90% of the capital coming from outside of the region, that can be an indicator that, for early stage VCs, it's not really the kind of model, because we were talking about before, right? Sustainable growth, CAC, unit economics, these kind of models go a little bit in the opposite direction. So, for early stage VCs focusing primarily on FinTech, e-commerce, and PropTech, which are, the major, I would say, bracket of verticals where the capital deployers are actually deploying fund in the region. It's a bit of a hard sell, especially at very early stages. So I'm a bit biased. I think it's an industry, it's a vertical where yes, there is some government push. If you manage to align your product and your vision with the vision of the government as well, that can of course benefit. If you manage to maybe involve and focus a little bit more maybe on the B2B side of things than rather B2C, that can potentially, make it a little bit more appealing. The fact that they're sourcing 80% of the material within Saudi, reducing costs, making them a little bit more efficient can, favor those, conversation around unit economics that we were making before, but I think it's going to be a hard sell. And please, Jamie, post this after the interview you're going to have with the founder, because I don't want to be roasted in a comment by on what I'm saying, just, a disclaimer.
Okay, so you both mentioned the government vision and the government support for this. I think Y Combinator as well, in the past few months, they publish every year the list of companies they want to see one of the companies or one of the strategies they wanted was focus on local manufacturing because of the political situation in the US with the tariffs on importing anything from anywhere now with the new administration. And in Saudi, there is a vision to focus more on agriculture. And Abu Dhabi, on the other hand, I know that Abu Dhabi is known for energy, clean tech. Is there a strategy for agriculture as well in the UAE, Julien?
Yeah, it's. I think it was made pretty obvious after COVID and the disruption, bottlenecks in the supply chain that we all faced, not only in UAE but in many countries. When you've seen pretty much all the shops like empty of fruits and vegetables, that was insane, right? So clearly food security is at the top of everybody's mind, not only government, but also just the retailers. They don't want to be in a situation when they can't service and sell to the customers. So when it comes to AgriTech, it's clearly long-term investments that requires quite a heavy capex, a lot of R&D, especially to customize, tailor, and localize to our regions. Not only in terms of produces you can get as an output, but also there's a bit of education to do on the end customers and the middlemen, the distributors, the retailers that might not necessarily be familiar with hydroponics and the type of fruits and vegetables and green leaf you can get out of that, and what's the it comes at a certain cost, and there's always the question like, do we have the same type of flavors and taste? So quite a lot of education. I think this is a typical example where like public-private partnerships would work very well. That's what's been done anyway with Pure Harvest, as I understand, if I understand correctly. And that's clearly need. Like we need to look at like again the longer term, not the 3, 5, 7 years horizon, as Andrea was mentioning, like typical VCs that we do, but it has to be heavily supported by government initiative like us. We actually start looking into AgriTech, clean tech. We've done 2, 3 investments last year into different startups addressing sustainability, and we'll again do more this year. But it has to be heavily backed and supported by the government at this stage, because you need to look at 15 years, 20 years down the line, not just like the typical 5, 7, 10 years horizon.
Now let's move to everybody's favorite topic these days, AI.
Yeah,
Jamie, we have a new AI startup.
We do, but this is a quite an interesting, exciting AI startup as well. So it bucks the trend. It bucks the trend to a certain extent. So yeah, we've Halo AI. So Saudi-based. Essentially, what they do, they connect brands with nano or micro influencers who have, I guess, niche audience relationships. And the whole idea behind that is, I guess, to enable those companies to achieve higher engagement rates and a better return on ad spend. The founding team is quite interesting. They hail from Meta, Snapchat, and Amazon. So they tick boxes on that front, at least, good on paper. And I guess in terms of the actual tech itself, so as mentioned, AI-driven platform reduces the brief to live time to 15 minutes, apparently, eliminates 80% of manual workflows, apparently, and delivers results which outperform traditional methods by 4x, apparently. So in terms of, I guess, partnerships to date, I know they've already had collaborations with, it seems like for the most part, F&B is sort of where they're focusing go-to-market. So they've had partner with brands Kitopi, Home Bakery, AOK Kitchen, etc. And it seems like they're looking to branch out from Saudi now as well. I know they've earmarked the UAE and Kuwait as the next markets that they're looking to go after. But look, it's quite interesting. It's an interesting, I guess, vertical AI use case. And look, the creator.
Okay, Jimmy, let me stay with you. You mentioned that, but can you dig deeper into this? So there's a lot of influencer marketing networks out there, right? But this one says they're AI powered or AI enabled. How exactly they're using AI?
It's taking the grunt out of connecting brands. So for instance, I think Kitopi is a good example, and that obviously they have such an enormous portfolio of brands under their umbrella. And I guess rather than manually matching with influencers and having to sift through whatever platforms that these brands have to sift through in order to find influencers that align with their specific target market. I think the entire idea with Halo AI is that it automates that process, and it is a pretty good read in terms of engagement metrics. So I think it just drastically reduces the time as far as that's concerned. And I'm sure it also, to some extent, I'm not entirely sure, but I imagine it automates reporting or something along those lines as well. And you can obviously maybe measure the impact of the actual ad spend via the platform too. Look, it's a pretty novel idea, but it's an interesting one. And the creator economy is only growing. Obviously, with the 1 billion summit, which I wasn't at only recently. It's a really fast growing sector. So, you know, these guys have the track record. Let's see what happens.
Okay, let's start with a little bit of a technical question for the VCs here. What metrics would you consider to evaluate such a company?
I think it's going to be definitely retention is going to be one of the biggest things when we're evaluating here from the businesses who are coming back to use the platform again. If the engagement rates and if the results of the campaign or the first engagements with the influencers were to their, satisfactory to their expectations, retention is going to be definitely a good one. And then how is this business? Because at the end, it's all about market potential. Like, is this, focus on this niche, the micro influencers and these size of them enough for the startup to have sustainable growth in the future? So having how the business model is built, how they generate revenue, is the market enough for them to support, is going to be definitely something that's going to have a lot of work internally for the VCs to do when deciding to invest in such thing. And of course, then the market reaction in terms of the retention of the clients. Are they coming back? Is the engagement with the influencer up to the expectations or not? Because here, I'm not sure how deep the AI is going with Halo. I'm sure, there's a lot of good things that the company is working on, but I would assume, the perfect scenario would be having detailed analysis of the demographics of the influencers. Are they up or do they suit what the company is looking for? Or even analyzing the right channels for them. So we're talking about, for example, Saudi, Twitter or Instagram or Snapchat. So which one is bringing them the most engagement? Which one influencer should be focusing more on, depending if we're talking about F&B, if we're talking about B2B or B2C or certain demographics. So these kind of things, the deep AI things, the company has access on and can analyze in order to, I would say, recommend to the influencers which channels to go on, and also recommends to the brands themselves which influencers they should be working on and which channels.
So you answered my follow-up question, which was, how can AI improve those metrics? But you already mentioned that. And I'm having a problem here with using the terms, because most of these influencer networks or marketing platforms, they have been using data science and machine learning to create recommendation engines and to enhance the experience of the brands and the influencers. So what's the use of AI specifically? I don't know. Andrea, what do you think? What metrics would you use to evaluate such companies, and how can AI improve those metrics?
I mean, we're still talking at a very early stage company, right? So maybe focusing too much on metrics, I would say, might not be the right approach. Like when generally speaking, when you look at a case, so pre-seed or seed, generally speaking, you want to look at the team. Seems as Jamie was saying, they're ticking the boxes. Had the chance to personally meet Vito a couple of times. Very, very brilliant guy. The solution they're building fits into, I would say, a couple of very interesting trends globally and regional. One, of course, it's AI. We're all investing in AI. We see AI everywhere. Second trend is that we're talking about region GCC, which is very, especially Saudi, young in terms of population, high tech adoption, extremely consumer driven. So also, influencers are taking care, are playing a pivotal role in that market. And if we look at also brands on a local and even a global scale, unless they have big pockets and they can afford large influencers, the micro to nano influencer, it's a huge trend, and I think it's not just a momentary phenomena, but it's something that is there to stay. So technically speaking, the solutions that they're building make sense in the context that they are trying to build it in. How AI is gonna basically, do all this improvement, a bit of a question mark, since I don't really know the model. Definitely the strong localization that they want to give to the solution, focusing on Saudi, focusing on Kuwait, focusing on Dubai, means adaptation of those models to the local ecosystem and local nuances. That's something that maybe other influencer networks that you were mentioning before were not doing correctly. Implementing those local flavors to models. That's something that maybe it wasn't perfectly done before. And then I think the entire streamlining of the entire operational process of looking for an influencer, negotiating, closing the contracting phase, and then analyzing real time, the campaign metrics. So giving a direct, overview of how the campaign is performing and direct justification of the ROI of your marketing spend. I think that's, the potentially what can be a very interesting advantageous points from their side.
Maybe just to add to that, personally, I don't necessarily see it as an AI startup, but more like a AI-enabled, AI-powered startup. It's clearly from the website, at least without knowing too much of the business, an AdTech operating in the creator economy. And to get back to your question, how you would measure the success of this basically is like based on the campaigns, right? Like it's campaign-based businesses. When a brand or sub-brand of Keto will want to connect with a bunch of micro influencers. In that case, you want to make sure that you have a high conversion rates, that you have quite a lot of UGC, so user-generated content being created, more than you would have by just having like a very standard campaign. And yeah, as Ayat was saying, the engagement rate. If you use micro influencers, so people talking to their friends and family, you want to have like a much higher engagement. If you look at the top influencers in the world, the 1, 2, 3 million followers, they have engagement rate of less than 1%. When you do micro influencing, you want to get to 15-20%. I know this very well because in a former life, I actually built a software to identify your top voices within your own followers. And usually you have people which are between 50 to 500 followers, but they're like friends and family, right? So those are the people you kind of trust if they communicate about a product because they care about a product. And for me, the limit of this type of model is you can scale with the numbers of influencers you will have on your platform. So you can bring more and more people like us, or maybe you are like top influencers, but I'm definitely not. I have like 150 followers. I'm happy with that. And we can bring a lot of people on this platform. But then if I start communicating every other day on a product that is not necessarily related to me, then I will lose credibility, which means eventually the campaigns will underperform. So this is for me where the limits of this business, this is a challenge the business will face, is how you scale the number of influencers, micro-influencers to engage with the campaigns without diluting too much the credibility and the core message of your product.
I love that, Julien. I love the detail. Yeah, go ahead.
Maybe, adding to what Julien was saying, there is, I would say, an inherent risk or issue with this kind of businesses when we're talking about campaign, which is, fake engagement, fake followers. So I'm not sure if they offer anything that can also guarantee an additional layer of transparency for the brands, because that's, the major pain point, right? I'm relying on an influencer, 15,000 followers, 50, whatever. I really don't know, if the engagement rate is correct one, if there is the percentage of fake followers. So if in that case, they would offer some sort of tools that does some, I don't know, data scraping or adds another layer of transparency saying, okay, the influencer is actually legit and the engagement rate is legit. Then it might be, a good additional selling point. Again, I'm not sure if they offer it or not, if they have it in plans or not, but I think that can be also a good potentially winning point for them down the line. And
the massive pro of Halo in that case is retention and loyalty, because if you like a product, if you use a product and the brand comes to you and say, hey, by the way, we've noticed actually you engage with us quite a lot. We want to offer you like this new sample, or we want to invite you to an event, just communicate on our behalf. That would be great. You feel loved basically by this brand, and you will be loyal customers, and you will communicate offline. That's just not will be limited to the communication around this campaign. It will go beyond, and you can become a lifetime customer basically of the brand. So that's for me the massive plus of Halo. It's more like retention and loyalty building than the pure like advertising campaigns that you can leveraging on micro influencers.
Well, okay, a relatively related question to this. We're talking about influencers. This takes me to social media innovation. We've seen over the past few weeks the TikTok ban crisis and then It's gone now. Everyone on TikTok that I'm following from the US were saying goodbyes, and then TikTok is back. It's all politicized, I know. But during that period, we noticed new apps coming up, like Red Notes from China. The people in America, they wanted to challenge their government, and they said, you know what? If you want to ban a Chinese app, we will go to use the most Chinese app, the Red Note or the Little Red Book app, and they started using it. But now I think they're not using it anymore because they're back into TikTok. But the question is, why don't we have new innovations in social media? Are we done with social media platforms? I mean, we have 2-3 big winners, the TikTok, Instagram, YouTube, and Snapchat, and that's it? Or are we going to see some new innovation with the Gen Z generation?
I think it's a
That's a tough
wave.
one.
So yeah, it's a very tough one, to be honest, because you can't, predict the market behavior and how they will react to a new social media platform, whether that's in our region, whether that's globally. So we've seen TikTok how it came and dominated, and in a night and day, it became the platform that everyone is using, and influencers all switch from Instagram to having TikTok as their main one. So I think we'll definitely see something new. It depends on how the market will react to it and how the amount of support that this company has. So it's a tough one. It's a tough one to predict, to be honest, but I don't think we're done. There's still, a lot of change in consumer behavior that's happening over the years that might result, in new platform coming on and dominating the market as well.
For me, I think like we'll see a shift possibly in the way we consume social media. And if you look at just the historical aspect of this sector, when Facebook created, there used to be an exclusive network, right? And then there's like you incorporate your friends and family, just a few people. Now it's just kind of like fully public. And then you had like the Snapchat and the TikTok of the world, because people want to have snackable content like on the go and non-stop. So again, that based on customer behavior. I have the feeling now this is changing, and that's pretty much evidenced by what's happening in the US and the fact that people are a bit revolting to those massive decisions. But I also have the feeling we want to go back to not the Facebook of the world, but very similar, with a bit more privacy and exclusivity than just everything being publicized online and accessible to everyone. So I don't think there's a right format at the moment, but eventually it's going to be driven by just customer needs and behavior.
Andrea, what do you think?
Yeah, I mean, tough one, right? Tough one, because we have basically consumer, which is us behavior in play, which is very unpredictable and sometimes even very hard to change as well, right? We've been used now to this TikTok and Instagram, where again, as Julien was saying, it's snackable content, right? You keep on scrolling, and you stay there for hours. So I don't know personally, if I have to think, what can be the next generation, how content will be consumed. I don't know, because again, we came to an era where attention span is now so short that bringing it back to longer content, I see it very hard personally. So I'm I admit my limitations. I'm very limited in this specific aspect. I cannot really imagine what the next generation of content consumption can be in terms of social media or anything like that. I struggle to see, at least in the foreseeable future, a drastic change compared to what we have now.
Yeah, I think when Peter Thiel invested in Facebook, the first 500K check, people thought he was crazy. It was a very contrarian bet, because at the time they thought social media was done, because MySpace dominated social media. But then, the rest is history. We have so many new social media platforms that came after Facebook. And when I first asked the question, I didn't even mention Facebook, because I don't use it anymore, honestly. But anyway, with that, thank you so much, Andrea, Ayat, Julien, for joining us today. This has been a great conversation. We learned a lot, and we would love to have you join us again soon. And for those out there who are watching or listening, please stay tuned for our new segment, Who's Raising and Who's Hiring. In these segments, we feature amazing startups that are raising capital and exciting new job opportunities that are available for you today. Before we get into that, let me tell you about our second sponsor for this episode, Rising from the Rubble, a report on entrepreneurship in Syria post-Assad, by Ahmad Soufiane Bayram from Black Box Accelerator. In this report, you can discover the untold story of Syrian startups, from challenges and opportunities, a blueprint for recovery, the return of refugees, future trends to watch, and community-centered development. You can connect with Ahmad on his LinkedIn account here. Now let's get back to who's raising and who's hiring. Our first company today is Starlist Technologies. Starlist is a platform that is revolutionizing the influencer landscape through its purpose-driven network. The platform brings together professionals from various sectors of the influencer industry to connect, collaborate, and thrive. Through Starlist, users gain access to an exclusive community where they can forge valuable relations, explore exciting opportunities, and access resources tailored to their professional growth. Starlist is raising a pre-seed round and is founded by Ayishmanta Jayasen. And here you can find the company's LinkedIn page where you can contact them. The second company we're featuring today is Hamsa AI. Hamsa is an Arabic speaker AI voice agent that masters the Arabic dialects. Hamsa is set to transform the way businesses communicate with cutting-edge audio solutions tailored for the Arabic language. It has a suite of tools designed to enhance engagement, improve accessibility, and streamline operations across various platforms. The company is raising a seed round, and they have a few clients already using the platform that is launched already. The company is founded by Auni Banna and other co-founders, and here you can find their LinkedIn page where you can connect to the founders. With that, thank you so much for watching and listening. See you all next week.